Part of our supply chain has been
We
fixed.
lost Wendy.
Yeah.
Oh.
So the supply chain was a mess because neither one of you were here on the last year. So we're operating at 75% efficiency for the show. Listen, the theme for this week or this month has been the beauty of the numbers. We got a great guest, Fuquan Bilal. He's a good friend of ours. He's in a lot of different real estate things. And would you be interested in buying a non-performing second mortgage? Most people are going, heck no. Fuquan's going to help us figure out why it's a great investment opportunity right after this. I'm always grateful to see these wonderful graphics. Every time we come here is a different set of graphics. So it's pretty awesome, huh?
A lot better than what we could do.
That's right. Yeah. So thank you for joining us on the Passive Accredited Investor Show. And while my teleprompter is not working, we are Carolina Capital Management. We're lenders in the Southeast for real estate investors. If you're interested in borrowing money, then go to carolinahardmoney.com and click on the Apply Now tab. If you're a passive investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, and sign up with Wednesdays with Wendy. So Wendy devotes 30 minutes per person every Wednesday to talk about real estate, anything real estate related. So sign up. Her calendar link is right there. It's also in the chat to the right or underneath your screen, depending on the platform that you're viewing us from. And if you have any questions or comments throughout the show, don't hesitate to leave a question or a comment. Right before we get started here, though, I would also like to mention the Wise Women Expo, the 22nd. And Wendy's portion of the event is going to be all about short-term rentals, but there's a great lineup of speakers for the 2-day event. Mm-hmm. Great content. Would you like to say anything? I'm going to take a breath.
I know, my gosh. Wow. You, impressive.
Yeah, well, you weren't on the last show. I did not have my A game.
Oh, was it a good one? I'll have to go back and watch it.
You know how much I like to hear my voice?
I know a lot.
I was getting tired of hearing my voice.
Really?
Yeah, so.
Because you usually talk to yourself as you write a journal that you later read. Yeah. Or do you have that audible now?
No, I don't write. I don't write. I don't read. I don't write. I listen and talk. All right. Without further ado, let's bring Fuquan on from NNG Capital Fund. Sorry, I missed it at the end. Thank you so much for joining us, Fuquan.
Absolutely, you guys are hilarious. So look, thanks for allowing me to be a part of the platform and share my journey with your viewers.
Listen, I love your podcast studio there. That's awesome.
Mm-hmm.
Well, this is actually brand new. This is the first interview in the podcast studio.
Wow.
Sweet.
We're honored.
I am going to figure out how to get our sound a little bit better. You got the nice baffles all over the walls. That really looks nice and professional.
Is that what that's called? Oh, that it was foam.
Foam there.
Yeah, it's supposed to absorb any possible echoes and that type of thing. I look up. We have microphones in the ceiling pointing down at us, and I'm always afraid it's going to come loose and pop me in the head. Fortunately, I have a big, those foam windscreens on it, so it shouldn't hurt too badly when it hits me. So let's get right into this second mortgage non-performing note purchases. I know most people cringe at even making a second mortgage to someone. What's the, why do you do it?
Yeah, so for me, starting off, it was really a way to give homeowners a reprieve, right? It was the easiest access point into the mortgage note space. At the time when I first got into the space, late 2011, early 2012, for me to pay 35 cents on the dollar for a first, when I could pay 6 to 8 cents on the second, made more sense to me. And it gave me the opportunity to deploy my own capital, go over the hill and get the arrows in my back first, figure out the processes, the systems, get some case studies so I can show investors. And then later on, that kind of led to a fund. The second mortgage space is quite unique because it gives you the option on a property, similar such as a subject to deal, right? I'm pretty sure a lot of your viewers are familiar with purchasing a property subject to an existing mortgage. That's the same concept when you look at the second mortgage space. You have equitable interest, you have an option on a property that's worth more. So instead of me going and spending back at that time 25 to 35 cents in a dollar for a first, for a loan balance that is 100,000 or less on a first mortgage, now I can play in my state, in New Jersey and other states where the property value is 250,000 plus, and I have an option from second position on this house. The other thing that intrigued me about it was that, of course, I would buy on mortgages, first mortgages, seconds on first that were performing. So the person is paying a first mortgage, but they're not paying a second mortgage. So what is the probability factor at that point where I would try to determine from their credit what other bills are being paid, what other bills are not being paid, did they file bankruptcy, did they go through some type of hardship? What I started to see from the due diligence was that this was the only debt that they were not paying. Maybe a few other ones they were not paying, but this was the only other major asset that had a lien on the property that they were not paying. And it was then borrow management that had to go into place to get them to perform. So it's just a low entry point to having equitable interest on the property. And it's a unique market. I would definitely say it's not for passive investors, definitely for someone who wants to be active because it's a business at the end of the day.
Sure.
Yeah. So the game plan is to go in, utilize your low entry point to modify the terms of the second and get them reperforming and then resell, or what are you looking to do with that second?
Yeah, that's a great question. When I got into seconds, it gave me the ability to give a homeowner reprieve to help those homeowners at that time. Back in 2012, there was mortgage companies had the bad name for foreclosing, and they sold off a lot of that debt. So that gave me the opportunity to buy the debt cheap and then go in and try to do a strategy like a loan modification. But not everyone wants that. You can structure something where there's a loan payoff, because I paid, at the time, maybe 10 cents or 15 cents in a dollar for this asset. Now I can share my discount with them. Case in point, if I bought a $50,000 loan for $7,000, but they still owe $50,000 plus interest, I can negotiate maybe a $25,000 settlement, less than what they would have owed, and maybe work that off to be paid over a year's time. That $25,000, I could be very creative. I can make flexible payments for a landscaper who, in the high season, have the money, but in the low season don't. So I can make terms based off the frequency of when they get most of the income. I can be very flexible and help homeowners. So that was really the thing that made me excited about the space. And my heart is still on fire for it today. I mean, it's very competitive now. Pricing is, 5 times more than what it used to be. But it's still a room for a discount and to get in at a low entry point.
Yeah, for sure. Yeah, that's, it's interesting. When I first got into the real estate space, it was on non-performing side. So I feel the pain. You're right. It's a very active space that you have to be in. I mean, you're a therapist. You're, your accounts receivable. You're trying to get those payments. You're the legal department. It's all kinds of things that you're doing when you're trying to tackle those. But you're right. I mean, so you can share your discount with people, and help modify them into performing or help them pay it off. What I found, I wondered if you found this as well. Most of those people who were not performing had the ability to pay this. they chose not to because the banks that they were working with chose not to work with them. So they got really pissed off and just stopped paying. I was shocked how many times I would talk to people and they're like, yeah, we can do a, like a, more or less a short sell or a discounted payoff, or we have the money to do that, or we can resume payments at a slightly discounted rate. Is that what you find as well with most of these, or what are you finding?
Yeah, most people, even attorneys that I would run across, not the foreclosure attorneys, because they were educated in this foreclosure space, but most regular attorneys or real estate attorneys or regular business attorneys, they didn't even understand the concept of it. They thought if you was to initiate foreclosure from second position, you have to pay off the first mortgage, right? That's just, most people think that. So the homeowners had that same mindset that I've learned in the borrower management process, that they didn't think we would pay off the first. They thought we had to pay off the first if we foreclose, and you don't. You can foreclose subject to the first mortgage if you have to go down that route. Our business model was, if we foreclosed, we failed. We wanted to work something out with the borrower. We wanted to share our discount with them. Now, if they stuck their head in the sand and didn't pay us, we have investors to answer to, so obviously we have to go down that path. But that's just one part of the business. You don't have to do borrower management when you buy seconds. I know a lot of successful funds that just turn paper. They buy it at X and sell it for Y. And basically that's their model. They don't do any collections at all. That's the collection part is really expensive. Borrower management and legal. I always make a joke and say the attorneys make more money in this space than I do because of legal and everything else. But you can have that model where you just turn paper. There's a lot of successful funds that just buy it in bulk and they carve out stuff that they want and they sell off the rest. We always make a joke that second mortgages are the orphans. So if they buying a pool of first, maybe some HELOCs may come with that, or maybe some at the time, those are HELOCs or home equity line of credits. They will scrape all that stuff out, or the low balance loans, anything less than $50,000. Maybe it's in places like Alabama, Ohio, or certain states, certain parts of PA where there's low balance loans. The big boys don't want to deal with that stuff. They'll just carve that out and sell it. And so you get some of that stuff with second mortgages also. And that's what actually introduced me into first, when I started to level up and have a fund and raise capital to be able to take down more loans. I started to see that I was getting first mortgages, low balance first mortgages, which is a whole different space. But I like seconds, again, for the reason that it gives me an option on a property. And, I'm protected by the first, the insurance that the first mortgage had. When they make that first mortgage payment, insurance, taxes, and everything is included. So I don't have to pay any of that. If I buy a first mortgage, now I have to put forced place insurance on it. And I have to do other things. Due diligence is more expensive. So it's just two different concepts. Both are great investments, but seconds is definitely a business.
Well, if you're operating a fund that has a lot of capital, it makes more sense to, buy by the case, sell by the bottle, so to speak, and then just make the spread on what you're going to sell these notes for. That's a very efficient model if you have enough capital to do so. And frankly, the places that are selling these notes would rather sell off a big chunk of it than have to, sell individual notes out to folks anyway.
Correct.
So are you finding that I know the note space is more expensive. You don't get the same discounts you used to, but are you finding more or less available inventory for notes now?
Yeah, so it's less opportunities for the price that I want to pay. I'll put it like that. There's always an abundance of opportunities out there, but with our model and what we have on the chopping block, so to speak, that we want to take down, there's less of that. And I'm speaking in terms of the equity position, the current senior loans that are less hairy. When I first got into the business, I would buy pools of loans and would sell off the high quality loans and would work the problematic loans. And that actually educated me faster in the space, working through assets through an uphill battle. And I would be able to recapitalize quicker by selling the creme de la creme, as they say, the best quality loans. So that kind of really helped me develop more relationships in the space with brokers, being able to turn stuff around and come back and buy again, because you're only as good as your last trade, right? So,
Sure.
And develop those relationships. Right now, what we're doing, the strategy is a little bit different. If we are looking at a pool and there's some good quality assets in there, but the equity is not as favorable as it used to be. But those are good assets, and they're in a footprint where we have in a space where we have the biggest legal footprint. We'll take those assets down, looking at them possibly as them being REOs, or we can actually rent them, create some type of arbitrage situation between the first and the second, between the first and what we was going to get on the second. And it's a tenant there now. We're paying the first mortgage, and there's a slight arbitrage payment. Equity is appreciating quite rapidly in many of the spaces. So we're looking at it from that point of view now versus trying to buy something that has a tremendous amount of equity and the first is performing. That's the highest price item. Everybody's fighting over that. Sure. So we're looking at that model as well. And our fund is pretty diverse. We buy more than just notes. So, but yeah, that's pretty much what we do with the seconds.
I was going to mention that you have a very diversified fund. Let's talk about some of the other assets that you're involved in as well.
Yeah, so we buy tax liens also. That's a way for us to get the properties at a discount. And that's only in New Jersey. We do the tax liens now. And basically, we've had a lot of success there, helping us to get properties that are off market, so to speak, because you're trying to buy stuff on the MLS these days. As you know, it's the line of 50 people waiting out the door for a showing. So the tax liens, that's a way for us to get off-market properties, get it at a discount, help revitalize the area. Special tax liens auctions primarily is what we focus on, which is different than a normal tax lien because in the municipalities that we buy these in, it requires us to rehab the property. We're not assigning them or selling them. We have to go through the whole process of foreclosing on it, rehabbing it, revitalizing it, putting it back on a tax roll, and then able to get the CO to sell it. So we've had a lot of success with that. That gives me my fill of importance going into these neighborhoods in Essex County, New Jersey, where I come from, and taking these blighted properties and putting them back on a tax roll. So, and we do them in bulk. So that was what intrigued me about the tax lien business, because it's almost like the note business. You can buy a pool of them and be successful in foreclosing on them and doing the renovation. We also do fix and flips and rentals also. Everything is related with real estate with what we do in the fund.
Well, that's pretty interesting that the municipalities are going to be favoring people buying the tax liens based on what they're going to be doing with the properties. So that's going to put the one-off tax lien purchasers that are just hoping somebody will pay it, and get their money back, or, to foreclose. That's pretty interesting that are they giving you a little bit of favorability in those municipalities to do, because that's what you're doing?
Yeah, so there's two types of tax sales. There's the general tax sales, like the one you just mentioned. The one-off investor will go buy and hope the homeowner would pay so they can make their 16% or whatever it is. And the other one is a special lien auction. These are on vacant and dilapidated properties that have taxes that are, $20,000 and higher. The bank is not going to pay the taxes because the property is in shambles. There are extensive renovations, 80,000 or more renovations. So those properties usually go to sell. And those are the special lien auctions that you can assign or do it. And we have the fast track law in Jersey. So if the property is vacant, we can fast track the foreclosure. It won't take 2 years. It'll take 6 to 10 months to get the judgment, and we will be able to start doing the renovations from that point on. There's some risk involved with it as well, because you don't own the property, and if the property catches on fire, you just get the lot. That you can't put insurance on it. But the upside is really great, and that's why I said it reminded me of the note business, because you can buy a pool of them, and get some very healthy returns from doing that.
Nice.
It's interesting. Yeah.
Oh, I thought you had
another
question.
I didn't know. That was really interesting. Didn't know you could do that.
Yeah, vacant property list. You want to source the vacant property list in your township, and then the next level is, okay, what are the taxes? Are there any taxes that are owed on these properties? Are they delinquent? And basically, once you take those down, it's less likely someone is going to redeem them and go from there.
Yeah, vacant property, you wouldn't imagine someone's going to redeem that. Yeah.
Well, and I was going to be a real smart ass about this and say, being in New Jersey, it's probably easy to get tax liens because they're the highest tax state in the country.
This is true.
Makes those a lot more available. No, that's great, because not only are you getting off market properties, you're able to put people to work in those communities. You're able to revitalize those communities, put those houses back on the tax rolls, and then homes that have been, blights or eyesores are now part of the neighborhood and homes for people to live in now. So
Yeah, that's our mission. Really, is to revitalize the community, create an impact, give local people jobs to help with some of the demolition and clean out and stuff like that. So it just feels good when you walk to the townships and the mayors see what you're doing, and the different departments, the tax office, the building department, everybody is behind you in that. So that's what we try to target. And we just actually now we're divesting a lot of the smaller rentals that we have here in New Jersey and creating this impact project in other states with the smaller multifamily units, 95 units and stuff like that in the same areas of like Alabama, Tennessee, stuff, those type of states that we can create that same impact.
Well, listen, you've carved out quite a nice niche for yourself, because I know investors all over the country that are going to stay away from New York and New Jersey and California because the foreclosure and the tenant laws are not in the favor of the bank or the landlord. And you've definitely carved yourself out a nice niche. Let's talk about your fund real quick. I know you can't get into details on it, but what kind of mix do you have between notes and homes that are being renovated and homes that are being held for long-term rent? What kind of mixture do you have in them?
Yeah, it's a 60-40%. So 60% of the capital that we raised is used to purchase real estate assets, whether it's fix and flips or if we buy rentals. And the other 40% is used to purchase notes. So that's how the money is distributed. And when our rentals are 85% Section 8 of that at women and children. So we have the cash flow that comes in from that, and that's what we primarily focus on. 2 years ago, no one wanted to deal with Section 8. Not everyone wants Section 8. So our fund is a hybrid. I like to call it a Kiwi. It's a little bit different than the other funds because we have that hybrid flexibility. We actually trademarked diversified hybrid real estate investing. The assets that we have in the fund is a buffer hedge against any market uncertainties. We got a great opportunity to see how it worked during COVID, and again the Section 8 and the government back payments really is what helped us survive through those months of COVID, those guaranteed rents.
Well, here again, you're doing good works in the community because it focused in on battered women and children aspect of it. So the tenants that you have in there, they definitely have a need for housing, and they're not in a economic situation of their own doing. So they're more grateful for what they have as far as a landlord goes.
Yeah, it feels good when you're helping out your community and helping out people like that. I mean, you're making money along the way. Your investors are making money, but the social impact is the most important
you're making
thing.
A difference.
And I know that Fuquan, that's the most important thing to him is the social impact.
Yeah, that's what gives my feel of importance. That's what makes me jump out of bed and get excited. I mean, we all want to make money, but it has to be a purpose behind it, and that's what really drives me.
Yep.
See, this is why we hang out with people like Fuquan to help raise our game and make us feel guilty when we're not giving enough back.
or eating a cheeseburger while he's drinking his
his go juice. Let me tell you a quick story about Fuquan. He was on this what's it called, the 75 hard.
Yeah.
And so basically you have this diet and exercise routine for 75 days, and if you miss it you have to start over. Well, he went through the whole thing, and one of his friends messed up, and he started over with him to make sure that that person had that good support group behind him. So I tip my hat to you.
Mm-hmm.
I couldn't make it through the first 30 days.
5 days.
Last diet I went on, I was told I wasn't going to be hungry, and all I ever did was think about food. So they lied to me.
So it's about lifestyles, right, Fuquan?
So yeah, that's right. Hey, Fuquan is definitely more motivated than I am on the fitness side of things. Jonathan and I are motivated, but not nearly as much as Fuquan is. That's for sure. Are you accepting current investors in your fund?
Oh yeah, we have we have a $15 million fund. We launched this fund the first quarter of 2020. We have about $3.5 million left of capital to raise. We actually just launched a Class D, which is a liquidity feature. It's a $50,000 minimum. It pays 9%, and it's a 90-day call option. We just launched that like 2 weeks ago, so I'm excited about that. And we have a Class B that's a 3-year term, $10,000 minimum investment. It pays 10%. You can compound that and basically earn up to 11.3% or something like that. And also we have a Class C, which is a $50,000 minimum 1-year term that pays 8%, and you can compound that also. You can't compound the D. That's the liquidity class. And I'm excited about that one because there's a lot of people who's looking for short-term investment. So, that was a good class that we just actually launched into the fund. So, yeah, we have about $3.5 million to raise more, and then we'll be off to the next fund.
You said 90-day call option, paying 9%.
Correct.
That's a good. I like that. Yeah, that's really good. Yeah,
that's very nice.
Yeah.
And just to throw that disclaimer in there, your mileage may vary. Read the PPM before you invest. Just want to make sure you're covered.
Consult your CPA, whoever advises you, your tax attorney.
Correct. It's only accredited investors, so people who understand these investments. We like to educate our investors before they come into the fund, so they know exactly what we're investing in, what we're doing, and it's all about relationships. So we're not looking for anyone who's chasing yield. We're looking for people who want to get behind our core values and want to help us create the impact.
That's well
Excellent.
said.
We have we take similar paths, but that's why we're all friends in this group, because we all have similar core values.
Scott asked a question. Just want to see, like, and it's the question we get asked all the time. What do you see happening in the future, Fuquan, in the near future? Do you see values continue to increase, or do you see a correction, a collapse, or what's your perspective on your market?
Well, until there's more inventory available and rates are low, we definitely see that values are going to kind of really not increase dramatically like they're doing now. It's crazy now. It's just I just listed a property in the market for $450. Within 48 hours, I got an offer for $500,000. We're out of attorney review and we're closing soon. Every property that I put on sale on the market has went over list 20 to 25% more than what list price was. So this is way crazier than it was in 2007. So I don't have a crystal ball, but I do see that if there's no inventory, interest rates stay low, and people can get the financing in place, that there's going to always, as long as they're appraised, that's going to keep pushing the values up. And especially in New Jersey, we have a huge migration from New York and Jersey City, which is almost like New York pricing wise, which is driving our pricing up in our market. And a lot of the affordable home markets, they're seeing people move over from the next state to take advantage of those low prices and low interest rates. So I believe we probably have a nice 24-month run before things kind of teeter off a bit. But that's my beliefs. That's what I see from the market space that I'm in.
Sure, and you're in that box where it's affordable housing. Everybody that I know that are in that median price point in their market, it's maximum 5 days on the market kind of thing, and they're always getting more than list. You start getting into some of your luxury markets, it's going to take a little bit longer, and sometimes they're having to come down on their prices. And, obviously, if you're somewhere close to a major metro area, that makes a big difference too. Fuquan, thank you so much for joining us. Do me a favor, Sharub, could you throw up his URL again for us? And that's a way to get information on your fund, right?
Absolutely. I'm grateful for you guys giving me the opportunity to be on the show and share my journey. And I like this format you guys have. It's very educational. And keep it up. This is very good. I'm right behind you. You see, I got the podcast from Ray. This is step one. And
well, what I'd love to have in the future would be a more depth, like in-depth dive on analyzing seconds or non-performers in general. If we could, you and I and Bill, if he wants to participate, I'm sure he'll have some nice anecdotal thoughts.
Absolutely. I love this thing, real estate. It's like therapy for me. I love talking real estate.
Oh
And
yeah. It's the same here. But yeah, I'd love to go on a deep dive with you, and I know a lot of our viewers would, and that would probably help a lot of people understand how you analyze the deal and then how you can effectuate the exit or the liquidation of that asset.
awesome. Let's do it.
Yeah.
Let's do it. I will say, it being in any real estate space, fixing and flipping properties or rentals is very active. I like for investors to have the knowledge. So if they're riding the coattails of someone, they know exactly the due diligence and what's going into place. So I definitely would love that. That's very important.
Excellent.
Yeah, we always talk about the educated investor because as fund managers, we would much rather deal with an educated investor than one that doesn't know, because when you do have a little bit of a downturn, which it always happens. I mean, life is not a straight line. There's no straight lines in nature. So they understand that there's ebbs and flows to anything in the market. So Fuquan, thank you so much for joining us.
Appreciate
Folks.
it.
Thank you for joining us. I hope you found the content to be good and enjoyable. This has been the Passive Accredited Investor Show.
Yeah.
We are Carolina Capital Management. We are lenders in the Southeast for real estate investors. If you're interested in borrowing money, go to carolinahardmoney.com and click the Apply Now tab. If you're a passive investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, and sign up for Wednesday with Wendy. Guys, appreciate it. Have a great week. We'll see you next time.